Welcome to Capital Link's Trending News podcast series. In this podcast series, we discuss with company management recent news and announcements they have made. I'm Nicholas Bornelis of Capital Link, President of Capital Link, and we have with us today Mr. Moritz Fuhrmann, Chief Financial Officer of MPC Container Ships. Our discussion today will focus on the company's Q1 2023 recently announced results, but will mainly focus on MPC Container Ships development, strategy, and the container ship sector outlook. A quick reminder about the disclaimer that the podcasts are provided purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and Capital Link bears no responsibility for their content. Now, MPC Container Ships is a leading container tonnage provider focusing on small to mid-sized container ships. Its main activity is to own and operate a portfolio of container ships serving intra-regional trade lanes on fixed-rate charters. At the end of March 2023, the group's fleet consisted of 62 vessels with an aggregate capacity of approximately 134,700 TEUs. And the company's shares trade on the Oslo Stock Exchange under the ticker MPCC. So Moritz, welcome. Thank you for being with us today. As I mentioned, our discussion will focus mainly on strategy, key issues related to fleet development, chartering, capital allocation, and of course, the sector outlook. So let's start with the first question. Your Q1 2023 results. You reported strong earnings, good results. Actually, compared to Q1 of 2022, these results were stronger. But of course, if we compare them to the last quarter of 2022, they reflect the weaker market conditions. However, it is interesting to note we had a container sector webinar just yesterday. And one of the points that came out very strongly by all four participants was that even though container ship rates have come down, they still remain quite higher compared to the historical average, and they are at very profitable levels. So tell us a little bit about market conditions in Q1 2023.
Yeah, thanks, Nicholas. We are obviously very happy with the financial result in Q1 23, which is a continuation of what we've been posting for the last couple of quarters on the back of the very strong markets that we have seen over the last 18-24 months. And the year started, so Q1 before Chinese New Year started, to be honest, from a chartering perspective, relatively muted. The big liner companies were almost silent, obviously having an impact on liquidity and chartering activity in the market. But post Chinese New Year, we have seen a strong uptick in activity and the big names coming back and actually supporting the rate levels that you just mentioned. So yes, we've been fixing also our ships from 1,500 up to 2,800 on very healthy rates, obviously significantly down from the heydays that we have seen, but from an historical perspective, still very, very healthy. But I think it's also very important to mention it's not only the rate level, it's also the duration. So historically, you have been fixing the smaller feeder ships on contracts for, let's call it 4 to 6 months, whereas now we're still fixing 12 to 18 months, right? So that's also a very, very encouraging, very positive development that provides obviously the company, but also the shareholders some cash flow visibility going forward. And also what we see on the operational level is that there was some negative implication also from COVID when it comes to crew operations, that having a negative impact on the OPEX, which is also now what we see phasing out slowly. So also from an operating expenses perspective, we could significantly improve Q1 over Q4 last year.
Well, the rates for Q1 were of 2023 were about 30,989. So these are still quite profitable rates.
That's true. I mean, we're still benefiting from the good legacy, so to speak, that we've been able to lock in, right? So when we locked in the good charter rates, the $30,000, $35,000, $40,000 per day, we've been able to lock in for up to 2.5, 3 years, which is still now in place. But obviously, over time that backlog is going to run down. But as long as we're being able to fix our ships that are running open now, 24, 25, at those levels that we see now, we're speaking of between $16,000, $18,000, $19,000 per day, depending on the vessel size. This is still very, very healthy level, very, very accretive to shareholders, and certainly enabling us to continue paying dividends to our shareholders.
So let's move now to fleet development. But by the way, I really like the way you feature it in your Q1 presentation, that you look at the fleet as portfolio, and you talk about portfolio management when it comes to fleet renewal and expansion, and then you talk about portfolio upgrade when it comes to investing in the existing fleet. So let's start with portfolio management. What drives your overall fleet renewal and expansion strategy? I mean, in Q1, you sold an older vessel, you acquired 2 newer ones with charters attached. You also have 4 new builds on order. So what is the strategy and the end game here?
So yeah, that's true. We sold 1 ship that was 20 years of age, was dry docking due, and was part of the joint venture that we had. So we decided, based on the age, we decided to sell. It was a good price, and we sort of could lean the corporate structure by getting rid of a joint venture vessel. 1, but 2, more importantly, is that the regulatory burden is becoming increasingly important, right? So going forward, the demand for more fuel efficient vessels will become greater and greater. So from that perspective, obviously, we want to position ourselves as early as possible when it comes to fleet optimization / fleet renewal. So yes, we have acquired 2 ships. I would say relatively young to mid-age, but they were scrubber fitted. They came with the charter attached. So from a de-risking perspective, very attractive. So when we look at new opportunities in the markets to renew the fleet, to optimize the portfolio, we will obviously assess the de-risking. So either you buy low from an asset price perspective, or you have a charter attached that gives you some rundown on the residual risk that you have. Obviously, also very important is the implied CI rating going forward, right? So you want to make sure that the vessel that you acquire is, fit for trading for the next at least 5-10 years, and not run into any trouble when it comes to be in compliance with CI and EEXI within the next 1 or 2 years. But also looking at our own portfolio, right? I mean, to be honest, the average age is now 15 and a half years of age. There are some vessels that are approaching 3rd docking, 4th docking. So we will very selectively look into each and every vessel in our fleet and assess, capabilities in the charter market, dry docking positions, what the current liquidity is in the S&P market, and whether it makes sense to sort of offload some of the older ships and ideally replace with a younger ship.
So on one hand, clearly, as you mentioned, you have this fleet renewal strategy with the older ships. On the other hand, you keep investing in portfolio upgrades. So let's focus on that for a moment. What any particular steps you're taking to improve the operational and environmental efficiency of the existing fleet, and where do you stand regarding the new regulations, EEXI and CII?
So from an EEXI perspective, we are in compliance, and that's the responsibility of the asset owner. When it comes to CII, it is a bit more complex because eventually the person or the company operating the ship is responsible for the compliance. And from our perspective, that's the liner company, our customers. So when it comes to vessels that we have on longer term contracts with liner companies, call it 2 to 3 years still, we have entered in strategic discussions, negotiations with them to sort of talk about specific retrofit measurements, bulbous bow replacement, propeller replacement, silicone hull paint. And if we're successful, then we're able to split the cost on those ships. When we talk about ships that are on shorter term contracts or in the spot market running open rather sooner than later, then obviously the expenses to make retrofits are on our own book, which we also incur because obviously we want to make sure that those vessels are also fit for future trading and retain the commercial attractiveness towards our customers.
What is the scrubber situation of the fleet?
Sorry?
What is the scrubber situation of the fleet?
We do. So we have installed a few scrubbers on the existing fleet. Then the two vessels I just mentioned earlier that we acquired are also scrubber fitted. I'd say around 25% of the fleet are scrubber fitted, and based on a current fuel spread, obviously there is value in having a scrubber, especially going forward. Obviously, you need to take a view on what's the fuel spread going forward, but we are from MPCC's perspective relatively confident that there will be a spread going forward, driving a further value if you're able to split the savings between the charterer and the owner, of course.
And I want to go back to the new builds that you have on order. You have 4 of them. They have dual fuel capacity, conventional fuel, and then methanol. So when you get them, you have the option of continuing to burn conventional fuel or go to methanol. Based on the discussions I have had with a number of people, it seems that all these green fuels, if and when they become available, they will be at a much higher cost. So who's going to bear the cost for the methanol?
Yeah, I should say from the 4 new buildings, 2 are dual fuel and 2 are dual fuel ready. So the dual fuel, they're actually capable of running dual fuel at the 1300 TUs, and they are on 15-year contracts with the Norwegian liner company that has a back-to-back COA with the Norwegian Industrial. So it's a very unique project from a container market perspective, which actually enabled us to go to the yard and contract vessels that are, from a pricing perspective, more expensive than conventional propelled vessels, obviously. And when it comes to the procurement of the fuel, the green methanol that the vessels are intended to run on, that's the responsibility of the charter. The vessels are being delivered in 24. It remains to be seen whether there's sufficient quantity available in 24. In all likelihood, there's not sufficient quantity available, but obviously the vessels are running for 15 years. So there's a certain trajectory going forward where you will probably see a fuel mix between conventional fuel and methanol, where the share of methanol is gradually increasing over time. And there's a clear intention to establish the first green corridor in the North Sea in Europe between Norway and the northern continent by using those 2 ships. So the clear intention from the charterer is to run the ships on sustainable fuels.
So we actually had a webinar the other day, as you know, on the container sector, and one of the big questions that came up for debate was, given the significant order book in the container sector, why would anyone place new build orders? And Konstantin Bak, the CEO, was very skillfully explaining your strategy of placing these new build orders with charters attached. So these are not speculative, new build orders. They are done based on agreements we have in place with the charterers.
Yeah, that goes hand in hand with my earlier comment that when we look at new projects, and it doesn't necessarily have to be second-hand market opportunities, it can also be new building, then we're very, very focused on de-risking. That goes to the comment of ordering speculative new buildings, which is not really on the cards for the moment. So if we were to look at another new building project, and there is a pipeline that we have, and also for new buildings, but those projects would always be together with the mid to long-term charter to provide some de-risking, right? So not entering into new builds and taking the full residual risk.
Now, moving to the next question, when it comes to your engagement with decarbonizing the industry, green fuels, exploring new opportunities, you do have an agreement in place with the McKinley Institute. I also saw that you you signed the industry's first offtake agreement for synthetic marine diesel oil with a German e-fuel company called Inerotech. So can you elaborate on this? What is this all about? Why is it important? What can we expect from that?
Yeah, so from a company perspective, from MPCC's perspective, we have committed quite early to the green transition, to an ESG strategy. We are quite transparent to all we do when it comes to E, S, and G. And to put the money where our mouth is, so we have been investing. I mean, not only talking about retrofits in our ships, but also looking a bit outside shipping. So we are part of the Maersk McKinley Center of Zero Carbon Emission, and we have indeed invested in a startup called Dividend in Germany. It's a very interesting project. It's for the very long run. So the company, as you mentioned, they're producing e-fuels. They have a few interesting mobility partners. So on the automotive side, it's Porsche. On the aviation side, it's Lufthansa. And on the shipping side, it's MPCC. It just gives us exposure to e-fuels. And that's also why we have the offtake agreement. It's actually a put-call option. So we have the option to take this fuel in. And it essentially, in theory, it could extend the lifeline of your ships, also of your older ships, running carbon neutral going forward, and also being attractive going forward for liner companies. But similar to green methanol, the jury is still out whether going forward you will have sufficient quantities to run a certain number of vessels globally on e-fuels. Remains to be seen, to be honest.
So staying on that topic for a moment, if you can share with us, I mean, what do you hear and what do you see in the industry in terms of efforts to decarbonize, to come up with new ideas, new fuels? From the various discussions we have had, there are two things that have stuck in my mind. That number one, conventional fuels are here to stay for quite some time. And number two, it will take a long time for the green fuels to become commercially available and attractive. And when they become so, they are expected to be at a different price level, which means that the cost factor is going to be significant and will impact freight rates. So what do you see happening, and how do you see the industry preparing for this?
Yeah, we do see a lot. I mean, as you can imagine, we do speak a lot to our customers, be it in Europe, be it in Asia, be it in the US. And there's all sorts of regulation being introduced. And there's certain regulations that are forcing you to reduce your carbon emission. I mean, you keep burning conventional fuels. Then there is new regulation being introduced to sort of penalizing you using conventional fuels. And obviously the theory is that over time, with the penalty on top, you would actually at one point be more expensive than alternative fuels, methanol, ammonia, etc. So from a propulsion technology, it becomes more concrete relative to 2 years ago, where there was still a lot of uncertainty, whether it be LNG, whether it be methanol, whether it be ammonia, maybe to a certain extent. And I think if you see the most recent orders in the container markets, at least, you can see a clear trend toward methanol. There is also some projects, very initial stage projects out there when it comes to ammonia propulsion technology. That obviously comes with a different risk owed to the fact that you're fueling a ship with ammonia. So I think that's even further in the future. So it remains to be seen whether that is a viable option going forward. But also when it comes to tackling the regulatory burden that is being imposed on the industry, there's some liner companies, but also asset owners like MPCC that are still struggling to understand implications, also the administrative burden and how to tackle. So our view is that over the next 12 to 18 months, there will be a lot of change, also short-term nature, that is drastically changing the industry. And also when it comes to communicating with the liner companies. So historically, you've been just talking to the chartering departments in liner companies, whereas these days you're talking to chartering, you're talking to asset management, fuel procurement, sustainability. So the discussion that you have becomes more complex, but it becomes also more strategic. And if you have positioned yourself like we did from a very early stage towards green transition, fuel transition, if you have committed to investing in startups producing e-fuels, if you have committed to ordering dual fuel methanol new building ships, then obviously you bring more strategic value to the table from a liner company's perspective. So we do have very interesting discussions on various levels, be it on retrofitting, but also be it on new building projects. So it's a very busy time because change is ahead, that's for sure.
Thank you. Let's move now to the next topic, chartering strategy. You mentioned before that you are currently experiencing longer charter periods compared to the past. So what is your charter cover and what is your chartering strategy in the current market conditions?
Yeah, we are in the lucky position to still benefiting from the legacy contracts that we have. So, financially speaking, feeling very comfortable with the remainder of 23. So let's call it 90% of our days are locked in. Looking ahead at 24. So from an open days perspective, you're talking about 40% open days. If you look at it from a relative revenue perspective, we are already locked in 75%. So also 2024 is sort of being in a comfortable position, regardless of where the market might be developing. In terms of backlog, it's still very healthy. We're talking about $1.3 billion on revenue backlog, around $1 billion in EBITDA backlog. So a very healthy position to be in, and also from an investor perspective, quite a compelling story, given also our dividend history and returning capital to shareholder. And when it comes to the specific chartering strategy, I mean, in the end of the day, we are market takers. So we take what the market gives, but we obviously try to extend the current period that we see when it comes to the rate level that we have, but also more importantly, the duration of the time charter contracts. So if that trend sort of continues, which is our expectation for at least 23, then we are in a very good position.
So usually the charter periods now have extended from 6 months to 12, 18, as you mentioned, or?
Yeah, that's correct. So historically, the period was relatively short, but also the redelivery window was wide. Whereas now we're talking about visibility on the contracts of between 12 and 18 months, and also the redelivery window has been narrowing down quite a bit, to be honest.
One of the topics also that came out in this container sector, this discussion that we had the other day, was everybody on the panel felt very comfortable with a very low, if any, default risk from the charterers. So it is interesting that exactly you have already secured a backlog of revenue. You're dealing with prime participants in the industry, and that the default probability from these counterparties is minimal.
Yeah, that's true, and that's an interesting point, because it goes a bit hand in hand with our current company valuation, right? I mean, we're trading at a significant discount to NAV. Our entire market cap is more than covered by the contracted backlog, disregarding any value of this deal. So as you can imagine, there's the questions from shareholder asking us, but also analysts, why is that? And one obvious answer is that people do not believe in the backlog that we have. But the simple answer to that, and just echoing you, the liner company's balance sheet is very strong. And yes, the sentiment might not be excitingly good, but despite the news that you're reading, the headlines about deep red numbers and revenues falling off the cliff, I think we're still, from a liner's perspective, we're still talking about the fourth or fifth best year in history, right? So if you look at the guidance by names like Maersk, for example, they're still guiding an EBIT in the range of 2 to 5 billion, right? Whereas historically, those companies, historically, meaning between the Lehman crash and COVID, for most of the quarters, the companies have been loss-making. So, and the EBIT obviously factors in the high charter rates that they have to pay towards tonnage providers. So again, from that perspective, we feel comfortable with the backlog. Also zooming into our backlog, 90% of our backlog is fixed to the top 20 liner companies, decent name, good credits. We have been historically refrained from doing business with the smaller freight forwarders that you see these days in the news, defaulting on some charter contracts. So again, a comfortable position to be in. Average duration of our contract is 2 years. So also visibility is very good. And our expectation is that over those 2 years, there will be no default from any of the big names, despite a reduction in the box freight rates that we have, or significant, I should say, reduction in the box freight rates that we have seen over the last 6, 8, 9 months.
So that brings me to the next question: liquidity and debt. You have very strong liquidity. Your debt at this point, you have 350 million in debt. The steel value of the fleet is 400, so scrap value more than covers debt. Your debt leverage is 15%. You still discuss about continued debt reduction, but you're already at 15%. I mean, what is the next goal here?
That's a fair question. When we say we keep reducing debt, it's simply based on the obligations that we have on the current debts outstanding. So by the end of the year, we are projected to be down by less than 100 on a gross basis, I should say, less than 100 million. So right now, on a net basis, we're at $28 million net debt. So it's almost zero. And I agree with you. There's at one point you could argue whether we use our balance sheet efficiently. Also from the perspective that we have more than 30 ships, or 50% of our ships being unencumbered. But also, you know, looking ahead and talking again about fleet optimization, fleet renewal. So that gives us a lot of optionality and balance sheet flexibility when it comes to funding those fleet renewals, right? So for us, from the management, it's always a fine balance between walking the talk and you know, keep returning capital to shareholders through the recurring dividend, which is being funded from the operation of the business. And at the same time, you need to renew the fleet, right? You want to be a long-term vehicle, and you need to renew the fleet, and that can be potentially can be funded by using a balance sheet. And in all honesty, there's some leads that we're pursuing now when it comes to new debt facilities that we might put in place to free up some of the equity that is currently bound in the unencumbered ships, and use those monies to buy new, more modern, more fuel efficient ships that are obviously complementary to the current fleet.
I mean, the flexibility that you have with the unencumbered ships in the fleet, it's an addition to the liquidity you already have in place. But if we focus on capital allocation, the usual destinations for capital allocation is fleet renewal that we talked, debt reduction, and then it goes to share buybacks and dividends. So if you can take us a little bit through how you prioritize amongst those, buybacks versus dividends, and then your dividends are comprised of regular dividends and event-driven. So if you can describe a little bit what drives the event-driven dividends and how they occur, and what can we expect in terms of dividend policy going forward?
Yeah. When it comes to priorities, and maybe quickly talking again about our debt structure, I mean, you should probably say that in good times you reduce debt, and in bad times you increase debt to sort of fund the operations of the business. So since the market is still good, we keep reducing the debts, and I would say with the same priority, we want to distribute capital to shareholders. So you've been referring to debt reduction between 2021 to now, from 350 to 150 million, and at the same time we have distributed $600 million in US dollars in dividends. And yeah, the question is whether you pay dividends or you do a little share buyback programs. We have historically opted for paying dividends, especially when talking to the largest shareholders in our stock. They're very happy with our dividend policy, and rest be assured that the dividend policy is there to stay. And that's talking about the recurring dividend, right? So where we pay 75% of an adjusted net earnings, and that's from the operational business. And you rightfully mentioned that we also pay event-driven dividend, or historically have been paying event-driven dividends. That's essentially driven by vessel sales, asset sales, whenever we're able to offload ships in the market. We also intend to return some capital to shareholders. Obviously, that's more to the discretion of the board. I mean, we have been distributing between 50 to 100%. So it depends a bit on you know, when we sell the ship, what ship we sell, whether there's at the same time or simultaneously is an opportunity to reinvest. So it's there's a few factors that come into the decision making when it comes to event-driven dividends. When we look at the 600 million that we have distributed, I'd say roughly 60% is from recurring and 40% is from event-driven dividends that we have paid in the past.
So in terms of the dividend policy, we can expect it to continue the way it is.
Yes, certainly when it comes to recurring dividends, as I mentioned, the event-driven dividend is a bit more to the discretion of the board. Obviously, we remain committed to returning capital to shareholders, no question. But since we are entering, especially 23 and 24, in a period where we are more focused on fleet optimization, fleet renewal, there might be an opportunity to recycle capital from an asset sale into an asset acquisition. But this is obviously driven rather opportunistically.
Now let's go to the last segment of our discussion on the sector outlook. So first of all, if you can take us a little bit through the characteristics of the inter-regional trades that you're focusing on, as contrasted to the long-haul routes, and what are the characteristics of the markets that you are dealing with, and what are they impacted mainly? I mean, how do high interest rates and so on, slower GDP growth, how do these impact your business?
Our ships, as you mentioned, are primarily operating intra-regional. So you have globally, you have the big hubs, Singapore, Shanghai, Rotterdam, Los Angeles, Long Beach. Those are the big hubs, the main lane trades where you see the big 15,000 plus TEU vessels trading back and forth. And from there, you have the small feeders coming into play, distributing all the cargo into the regional market. So I think Singapore is the prime example, also being one of the largest container ports globally, where a lot of throughput is generated every year. And from there, you have small feeders operating into Thailand, Indonesia, Philippines, and other nations, Sri Lanka. So that's a more short-haul business, and going into those specific regions, you naturally have more physical restrictions. So larger vessels are not able to enter smaller ports. You have some infrastructure restrictions, especially when you look at Africa, where you have port facilities without cranes. So you preferably have container vessels that have cranes on board to load and discharge cargo in those regions. And if you look at the entire container fleet, and not from an TEU perspective, from a number of ships perspective, the lion's share of ships is being operated in the inter-regional trades. And what we have seen historically is a positive trend, a very positive trend on a compounded annual growth rate when it comes to demand growth for TEU throughput. So actually a very healthy segment to operate in if there wouldn't be overbuilt, right? If there wouldn't be supply pressure. So if you were to look at demand growth historically, you would see that the inter-regional trades are growing on a more resilient basis relative to the large east-west trades. But again, you always have the supply side implications. When it comes to the current environment and talking about inflation, that obviously goes for all container segments, right? Be it large vessels, be it smaller vessels. Obviously, inflation is impacting consumer spending. Luckily, at least in the US, we've seen, or it seems that the inflation is peaking. We're talking right now about 5%, and hopefully we continue to see a negative trajectory when it comes to inflation. So consumer spending might be picking up again, obviously being supportive for the container trade. And again, when we look a bit more, look a bit more in detail about the Southeast Asian countries, what has been introduced there over the last couple of years is the RCEP, which is the Regional Comprehensive Economic Partnership amongst all those little, I wouldn't say little, but all the smaller nation in that region, which is enhancing or which should be improving the trade in between those nations, and that would certainly benefit smaller feeder ships. So from that perspective, again, the segment that we are operating in, and we are the largest tonnage provider in the feeder segment, we feel very comfortable with the intra-regional trade, despite some clouds that you might see at the horizon from a demand perspective, but also certainly from a supply perspective.
So last question on the demand. Is China playing a smaller role, and are other countries playing a bigger role in these trades?
The China conflict?
Yeah. I mean, is China representing a smaller portion of the trade right now, and you have other countries picking up?
Yeah, you have certainly seen, and especially since the COVID crisis, where a lot of Western countries that are producing in China, which used to be the workbench, we have seen significant supply chain restrictions. So they've been venturing into other countries in that region, where actually labor costs are lower now these days than in the eastern part, at least in China. So talking about Vietnam and Philippines. So yes, you certainly see a shift towards those countries, and we also see a shift in terms of the capacity that is being deployed when it comes to calling those ports. So you see a slight uptick in container sizes. You know, historically Vietnam has been, have been attended by vessels of up to, I don't know, 5,000 TEU, and you see a slight uptick now, also larger vessels going into that region. But if you look all in all, and not only talking about Vietnam, but also other countries in that region, that certainly should be beneficial from a feeder perspective, because eventually what is being produced in those countries and loaded in container vessels will end up in Singapore, and from Singapore then being distributed to the western part of the world primarily.
So now moving on to the supply side, clearly the situation on the order book is very different if we look at the larger sizes contrasted with the smaller and mid size ships. So can you take us through the order book and the implications for your business?
Yeah, simply looking at the order book, it's certainly daunting. We're talking about 30+% of the current fleet on order. If you look into it in more detail, it obviously becomes a very interesting discussion, because it's clearly to see that the lion's share means around 80% is skewed towards the larger sizes. So 80% is accounting for 8,000 plus TEU, and those ships are not really relevant for the intra-regional trade. Whereas the order book for feeder vessels, where MPCC is operating in, has also been increasing, no question, but it has only been increasing to a level of, I think, talking about 15–18%, which in our views is manageable, just from a pure demand perspective. But more importantly, you also need to look at the age structure of the subsegments, right? So the larger segments are fairly young, so you will see a limited scrapping potential, limited replacement need. Whereas in the feeder segments, you have there's 1,000 ships in the below 3,000. For just to give you an example, there's 1,000 ships in the below 3,000 TEU segment that is older than 20 years. Just to put things into perspective, right? So there's potentially going forward, there's quite a significant scrapping potential. One. Two, you have, if the fleet is older, and also talking about the introduction of regulation, those vessels will be forced to slow down, and slow down will also have a significant impact on the supply side. So yes, overarching, the order book is heavy, but if you drill down into the specific segments, you can see that the feeder segment is actually quite attractive. And it remains to be seen how the market evolves from a rate perspective, but just purely looking at the supply side, we think it's a manageable order book in the 5,000 and less TEU clusters.
So on this, on your segment, on the mid smaller ships, you have lower order book, further to be positively impacted by slow steaming and scrapping.
Yes, yes. So we tried to do some calculation on slow steaming and implication of regulatory burden, and from our perspective, there could be a supply side implication of 6 to 7% by slowing down the fleet by 1 knot, which is significant, right? So you're talking about an order book of up to 18%, slow down by 1 knot, you have 6 to 7% positive implication, and on top you have a natural replacement need. You will have a natural scrapping pattern that you will see over the next couple of years. So there is sufficient factors that can be absorbing the order book in the feeder segment and lead to a healthy supply balance.
So we have come to the end of our discussion. I would like to thank you very much for what I think was a terrific discussion, very detailed, very insightful, and we covered a lot of topics. Any closing remarks in terms of what's next for MPC?
The closing remark. I think to close the discussion. So when we started out in 2017, obviously there was a certain idea around MPCC, being counter-cyclical, acquiring ships at a low point in the cycle, and when the market turns, then we can flip the asset, the typical Greek asset play. However, the market has developed in a form that no one really expected it to happen, and all of a sudden, the business model of MPCC changed quite drastically from an asset play to a long-term dividend vehicle, right? So that's why it's so important for us, for the management team, to preserve this long-term vehicle and renew the fleet, optimize the portfolio, and keep returning the capital to shareholders as we did over the last 1.5 years.
Well, again, thank you very, very much. I really think it was a great discussion, and we look forward to the next one.
Thank you, Nicholas. Very happy to be here.